Greetings from 3Edge Asset Management and welcome to the 3Edge Week in Review for the week of December 7th, 2020. I'm Fritz, Folts, the Chief Investment Strategist here at 3Edge, and I'm pleased to have a special guest with me here today, Dan Zraly. Dan is Managing Director and Chief Trader here at 3Edge Asset Management. Dan, welcome to the Week in Review.
Hi, Fritz. Glad to be here.
With Dan in the house this week, we'll be exploring the many aspects of trading ETFs in the markets and how expertise in this area can add value for our investor client. Before we get into that and talk about trading ETFs with Dan, let's just take a quick look at where we are in the global capital markets as we enter into the final weeks of December. As we remember, last month in November, global equities provided the kind of investment returns which could be considered a good year. And all of that came in just 1 month. However, equities thus far in December have been mixed. Cases of coronavirus are surging throughout the U.S., and it seems now that the stock market is a bit in limbo, waiting to see if Congress can come to an agreement on the next round of COVID relief, as the original aid package is set to expire at the end of this year. And what we've experienced a lot in December is that when it appears that perhaps Congress will come to an agreement, markets can move higher, and then if the talks seem to stall, then markets go back down again. These negotiations are obviously important because we need this coronavirus relief to get us to the other side of the pandemic when the population will be vaccinated and hopefully the economy and all of our lives can go back to normal. So let's turn our attention to the topic of trading ETFs. This is obviously an important topic here at 3Edge because we construct our client portfolios primarily of index ETFs. And so to take our deeper dive into this topic, we'll bring Dan into the conversation. As I mentioned earlier, Dan is our chief trader. He's a managing director here at 3Edge, and he has 20 years of industry experience. Prior to joining 3Edge, Dan was a director at Deutsche Bank, where he was the head of ETF Trading North America. And as we know, the role of ETFs has grown dramatically from what was a cottage industry in the early 2000s to today, where there are over 2,000 ETFs and counting. In addition, total assets in ETFs is growing at over 20% a year. It's projected to reach over $5 trillion by the end of 2020. Another note about ETFs is Steve, our Chief Investment Officer, along with many of our core team members here at 3Edge, are regarded as pioneers in utilizing ETFs to construct globally diversified portfolios. So Dan, since there are so many ETFs to choose from now, what would you say are the key attributes that you look at when it comes to deciding which ETF vehicles to utilize when constructing client portfolios?
Yeah, great question, Fritz. As you and I know, as we're both on the investment committee and with the rest of the investment committee, we spend a good amount of time on ETF selection. We want to do what's right. What we've found is we want to pick ETFs that match our research and fit well in our strategies. As you know, at ETF, the machine part of the human plus machine investment approach, the machine part is that proprietary tactical quant model that we have at 3Edge that uses artificial intelligence, machine learning to detect and minimize portfolio drawdown and by tactically reducing risk, and then invests in undervalued asset classes that are poised to enter a period of outperformance. But because of the tactical nature of our research and our strategies, which are not buy and hold, they're tactical, ETF liquidity plays a major role in ETF selection. We don't want to spend a lot of trading costs when tactically moving $500 million, for example, from one investment to another. So we use ETFs that are the most liquid, and ETFs that match our research output. And then we use trade cost and attribution analysis tools to ensure that we're achieving our goals, that the ETFs that we're selecting and trading are not taking away from the performance of our strategies are generating.
Excellent. So one other question. I know that another thing that we that you look at and we look at is this idea of tracking error, and that's often discussed in the land of ETFs. Could you just explain what actually tracking error is and why it's important in ETF selection?
Sure. ETFs generally break down into two categories, active and passive. Active ETFs don't have any tracking error because they're not tracking anything. They're just implementing a strategy inside of an ETF, while passive ETFs are tracking an index. Their main mandate is to create the same performance that an index has. So outside of things like management fee and expense ratio, which are things we also look at, you're right, NAV tracking error is one of those things that tells us how well the issuer or the portfolio manager of that ETF has done tracking and that index that he's benchmarked, that he or she is benchmarked to.
Very good.
ETF premium and discount is actually something else we look at as well to see how well and how big of premiums or discounts the ETF itself has had versus its NAV. So those are all things we look at when we do ETF selection.
Very good. Excellent. So now I think it would be helpful if you could explain exactly how you go about executing a trade. So once, and you're on the investment committee, we're both of us are. So once the investment committee has made a decision to make a change in the portfolio, what is the process that you then go through to initiate those changes in the strategies?
Right. So arbitrageurs, ETF arbitrageurs, market makers, ETF liquidity providers, those are the backbones of the ETF industry. What they're doing is they're doing both high frequency arbitraging and market making on exchange and putting bids and offers out there and replacing them hundreds of times per second. And those bids and offers, we are able to buy and sell. And those ETF arbitrageurs are making small spreads and of ETF versus like hedges. And it takes a lot of technology and experience to do that. They're also doing over-the-counter big block ETF trading, where a market maker is trading with folks like us who have to trade large blocks. And they're also making a small spread by doing that. As they do that throughout the trading day, those market makers and arbitrageurs are creating big, large risk positions of ETFs versus hedges. That means that one of them, of all of them, are at any given point, they might be better positioned to offer 3-edge a more competitive price.
Right.
And the only way for me to find that out is by putting them in competition for our ETF trade. So I have trading technology that helps me do that. And as a result of selecting the most liquid ETFs and the way I just described to you, the way we trade those ETFs, most of the time when it's time for me to move $500 million of an ETF, I can get it done on the bid or the offer, which usually don't have to spend a lot of trading on trading costs. And that minimizes any possible trading impact on our strategy performance and keeps more money in the pockets of 3-edge clients.
Excellent. Excellent. I actually have one question. It's sort of, I think it's topical this year, because one of the things we've seen this year is more retail investors, more retail, what we used to call day traders into the market. And maybe that's a function of the market, went up so strongly there from the end of March. But have this wave of this influx of retail traders, has that impacted ETF trading in any way?
As retail holdings increase with the increasing ETF market, I think in history there's been a couple instances where ETFs themselves are having an impact on the underlying indexes and the underlying assets. Things like volatility ETFs. Even the ETF market is close to $6 trillion in assets. I think that's right around where it is right now. If you just take a look at something like the S&P 500, I think that's 1/10 of the 6 trillion. So let's just say 600 billion of ETF assets are indexed to the S&P 500. There's tens of trillions of dollars indexed to the S&P 500 in the form of the underlying S&P 500 itself, futures, options, swaps, etc. So with that 600 billion, the ETFs might have brief moments of impact on the S&P, but when it comes to day-to-day moves and something like the March sell-off that happened earlier this year, ETF holders are just along for the ride, and the dog is still very much wagging the tail rather than the other way around.
Excellent, excellent. Thank you, Dan. And thanks for sharing your knowledge and expertise around trading ETFs with us today. Very informative. And you've shed light on an area of our business that is hugely important, but that our clients may not always be aware of.
Thanks, Fritz.
Thank you. And so that will do it for Dan and me for this edition of the 3Edge Week in Review. Steve Cucchiaro and I will be back again next week. As a reminder, all of our videos are available on our 3Edge YouTube channel, and you can subscribe to the 3Edge YouTube channel as well, which simply means that you'll be notified as we release videos in the future. Also, always feel free to share these videos with anyone who you think might be interested. So on behalf of everyone here at 3Edge, we urge you to remain safe and healthy, particularly as we may be in store for some tough weeks and months ahead with the surge in cases of coronavirus. So take necessary precautions to stay safe, keep the faith, and thanks for listening.